Welcome to this episode of Hidden Money. This is episode 5 of our real estate series. Kevin and I are super excited and thankful to have one of our friends, our clients, and an amazing syndicator, Jack, here to join us and talk more about syndications. We've covered different ways of investing in real estate. We're covering the tax advantages. There's always tax advantages, especially on the hidden money. But we want to talk about investing in a syndication, which is a very good way and optional way to invest in real estate. And as Kevin and I always talk, diversification in your real estate portfolio is key. And investing through some syndications is great. So thank you very much for being here, Jack.
Yeah, it's my pleasure.
Yeah, if you wouldn't mind, just tell us a little bit about yourself, because I know not everyone kind of grows up and be like, you know what I want to do? I want to raise money and buy big apartment complexes, you know? So how do you, tell us how this story started and how you got where you are being a syndicator?
Sure, happy to. So way back in my early career, I was a finance guy, right? Worked in the corporate treasury, and when I was at General Motors, one of the roles I played was the secretary of the investment policy committee for the pension plan. And that's a mouthful.
That's a big title.
So that's a mouthful.
Say that one more time.
Secretary of the investment policy committee for the pension plans of General Motors.
Did you have an extra long business card back in those
No. Basically, I was a peon then. I was just out of business school and I was taking notes.
Gotcha.
But I learned a lot, and we had $20 billion invested for the salaried retirement plan, and then a separate $20 billion or so for the hourly retirement plan. And one of the, they use, of course, different asset classes to invest in. And one of the asset classes was apartment buildings. And, I'd lived in apartment buildings, but I never really thought about who owns these and,
Right.
What kind of business is that? And as I navigated through my career, I climbed up to the ranks of corporate CFO and headed up global mergers and acquisitions for a Fortune 500 company. And along the way, became aware of some groups that were raising money to buy apartment complexes. So about 13 years ago, I did my first apartment investment as a limited partner. And, the role of a limited partner can be glorious, right?
Yeah.
The work you have to do is limited.
Zero, almost.
Zero, yeah. Well, the real work is finding the right people to invest with,
Right.
Not just the people, but also the projects and all that. But so I invested in a syndication. It was probably 50 grand or 75 grand, a while back, as a way to diversify my money and in my investments. And I watched this group doing it, and I was thinking, wow, I have a Harvard MBA. I have an undergrad in finance and accounting from Notre Dame. I've run all kinds of different companies from a CFO, COO perspective. I've done business valuations, and I was like, wow, I think this would be something interesting to get involved with, more than just as a limited partner. So, fast forward 10 years, I've definitely invested in over 20 apartment complexes, and been the general partner of multiple deals, and also helped some people raise some capital. So syndication is a tool for raising capital, and a very effective one, not just for real estate, but for other ways to raise, other types of businesses that need money. But there's a real sweet spot with real estate.
Let's talk about real quick, just for those listening who maybe don't know what a syndication is. I assume most of y'all do know, but just on the 101, how do you define what is a syndication? It's a fancy name for a partnership.
Sure. Well, there's kind of a spectrum of raising money, right? So you've got all the money and you go buy the apartment complex. That's one way.
Yeah.
That's
not me.
That wasn't me either, right? So another way is, you got a group of people that you want to, you form a partnership and you're all members and you figure out each other's roles. But then this syndication method is a way to raise money from people that you don't have a relationship with. It's a legal way. There's a safe harbor for how you can raise money in the process you follow. You need a syndication attorney. Mm-hmm. You also need some great tax accountants. You need a team, really. Yeah. And part of the capital comes from individuals that get to know you over time, and it's a way to raise money is essentially what a syndication is, and there's legal provisions on how you structure that. Right. And that's all reflected in your company operating agreement or your company agreement. and in this document called a PPM, or private placement memorandum. So,
Yeah, and there's also limitations on who can invest. You can't just take anybody's money off the street. They have to be accredited, which accreditation, you have to have a certain income threshold or net worth income or net worth threshold to even invest in these deals, because you have to be educated on what you're getting into. These are risky, like any investment out there is risky. I don't care if you're in the stock market, you're buying your own property, or you're in a syndication, there always carries risk. If there was no risk, there would be no reward and everyone would do it, right? So,
sorry, I got to go on the soapbox for just 1 second.
oh, go for it.
Syndications, in my opinion, especially if you do some due diligence, they're no more risky than investing in the stock market or Bitcoin, which I still don't understand that stuff. But I don't like it. I don't think it's fair. And Congress is apparently going to take this up again this year, and I've been hearing this for years and years. It's not fair that if you're not a millionaire, you're not allowed to invest in these syndications, because I think a syndication that owns real property, that's managed well, that's not over leveraged, is a lot safer than a lot of investments out there. And I don't think it's fair that someone who is not a millionaire or has whatever, becomes an accredited investor through the thresholds, can't invest in that. But right now that is the rule. And I think the meaning behind that, it's a good intent, was, hey, we're not going to require that, the Securities Exchange rules say, for syndications, we're not going to require audited financials. We're not going to require the $1 million a year worth of due diligence that public companies have to do. So we're going to allow smaller companies and businesses to raise money and go do businesses together. So the SEC came out with this accredited investor rule, and it's in my opinion, incredibly unfair. But write your congressman, your senator, ask them to change it, because they are currently considering that in Congress again, of lowering that threshold.
Yeah, the rules around being an accredited investor definitely shut some people out of the ability to invest. And I think that there's a spectrum of people's risk tolerance as well as business acumen. And I can understand why they have the rules in place, but I've met some very sharp people that have some funds. They don't qualify as an accredited investor, but they want to put money in real estate, and feels like they should be able to do that.
Sorry, I jump on soapboxes every once in a while, Jack. I'll drop it now.
That's okay. That's okay. But yeah, so whenever you're structuring a deal, there's multiple steps. You already hinted at it, that you need an attorney, a tax person. You need all these people working together, because the way y'all structure y'all's deals, it's very unique from another syndicator who has a different goal. Just because two independent syndicators could structure their deal way differently buying the exact same building. Yes. As an investor, you need to know kind of what that looks like in what you called the operating agreement. Yes. So what are some unique things that you've done or seen in the operating agreement for the limited partners on return or depreciation allocation? What do you see in there?
I like the phrase, keep it simple. It's really difficult to do in a complex real estate
attorneys
transaction.
And tax people, we have to make it.
The investors need to understand what they're potentially getting into, right? So I like to have a very simple structure on how the waterfall works, which is how do the general partners get compensated, right? I mean, you're not going to do this work uncompensated. It is a
lot of work.
It's a lot of work. Like, if you have a fire, or if you have, a key employee quit, you're going to handle that no matter where you are or what you're doing. And I was just up in the wilderness and got a call from my property management company a week or so ago, and had to go find some cell coverage and handle it. But anyway, the syndication is a way to structure the transaction. There's lots of different ways people do it. Some of them have very complicated sharing structures, like, you hit this hurdle and that hurdle. And I understand, there's a marketing aspect to that, but I like to keep it simple with a 80-20 structure where the partnership members, will get 80% of the, proceeds of whatever the sale is above their original capital investment. So you can set up the structure in a way that's very easy to follow in terms of, we get all our initial investment back, and then after that, it's an 80-20 split with the operator. There are some deals I've seen where it's a 50-50 split after the initial capital is back. So that's very favorable for the operator.
Yeah. There's some deals that it's 80-20 from the beginning, where people don't get their money back before they start splitting. So every PPM, private placement memorandum, is different. They're not all created equal. And I would say, from my perspective, and if you're going to get into investing in syndications, understand how that works. I like to know, if I'm going to invest with a syndicator, that they have skin in the game, that they're not just going to make money whether I lose all my money or not. So I like how you do full payback before you get your carry, or that 20%.
Yeah, I have a set of questions. I invest in syndications myself that I'm not even the general partner of, right? So, the first thing I want to know is, who is the operator, the general partner, and what's their track record? And I'm going to talk to people that have invested with them before, and I'm going to get to know them. That's a really important part of the, of the process of deciding to invest in a syndication or not. That's even before you get into, this is a shiny building, right?
Yeah.
Oh, I like it. It's in a great location. Or, wow, look at those returns that they're promising, right? So, one, the operator, the people involved is key, but then also, understanding how they get compensated, how the investors get compensated, and what kind of skin they have in the game. There are a lot of syndicators that don't put any money into their deal.
Yeah.
And there needs to be a right-sized amount. I think it's 5 to 10% of the total capital raised. Probably needs to come from the syndicating group, the general partner team, or more than that. So there's a lot of different facets to consider, but reading the documents is important. I think some people that have done a syndication or two as limited partners, they get into some trouble because they just assume that the documents are all going to be the same, and the sharing is going to be the same, and they're a general partner. They should be in this role. I should trust them. And it takes time to really get to know people and understand the documents and all that. So
And it's a very cool way to invest into real estate. Is if you're going to target a $10 million property, you're performing the same tax strategies we talk on an individual level with individual investors.
Yes.
And depreciation is a big part of that. Now, with the One Big Beautiful Bill Act that came through, we have 100% bonus depreciation.
It's back.
So
Yay.
we can actually shift a lot of loss to our investors. And we just, in our last episode, we talked about real estate professional status and how you and Alan, being GPs, you get to take that loss because y'all are materially involved in the partnership, y'all are real estate professionals, but your limited partners, that may be tied up as passive, but there's ways for your limited partners to get that depreciation y'all are generating and giving to them to be deductible against their W-2 and active income. And that's the beauty of investing in real estate syndication, is understanding the individual tax situation. Because let's say someone's a limited partner and they invest $50,000 and you give them $40,000 of loss that first year from bonus depreciation. That could be passive.
Yep.
But also, that passive loss that you send to your investors, if it's not deductible, it carries forward with them into future years as a passive loss carry forward. So now, in the future years, when y'all are collecting rents and doing distributions to your investors, that's income.
Yes.
But not to the investors that have this passive loss carry forward. So they almost get tax-free distributions from deals like this for years.
The cash distributions are generally tax-free throughout the deal.
Compare that to investing in the stock market, getting a dividend that you're having to pay tax on, whether it's 15%, 20% or more. You're paying tax on every dollar you get back, but in a syndication like this, that's where one of the tax benefits are huge. You're getting tax-free income for a number of years, potentially
if it's structured right.
Yeah,
not every syndicator's
No,
built
it's
the
got to
same,
be structured right. And when we started working together, I came in for a consult, and then you guys asked us to send us, our draft incorporation documents, our partnership agreement and other things, and you had great content to add to those, to change them, to make our position stronger with the IRS. That's what's fascinating about, the IRS. The tax code's only this long, and all the regulations and rules, it's like if you had all the books lined up, it's like 30 plus volumes, right?
But then you have case law, tax court case law, which is 20 times more than the regs in the Internal Revenue. I love that.
And we have to know it all by heart, by memory.
We just have to know the good stuff. We know where the gold's at.
I just know that I call you guys when we, when we're diving into the tax aspects of deals, because there are answers, and there's multiple answers that could be right. It just depends on the situation, and really exploring that together, something we've done successfully several times. So.
Hope you've been enjoying this episode of the Hidden Money Podcast. more importantly, I hope you've been learning some value. Taxes can be one of the most beneficial assets in your pocket. If you already have a good tax strategist, that's wonderful. Work with them. Use our podcast with them. But if you don't, or if you have questions and you're wondering, is it time for you to take the next step? Check us out at revotaxpayer.com. Again, that's revotaxpayer.com. Kevin and I have built an amazing team that does this stuff in each of our episodes, day in and day out. We don't think like a normal CPA. We're not just plugging numbers and getting your tax return done. We are changing your life by helping you change your facts to change your tax. Again, that's revotaxpayer.com. I want to hit on something that Kevin mentioned. So if you are a real estate professional, and we mentioned in our previous episodes, episode three or four, we mentioned you have the ability to group your activities as a real estate professional to get active losses from normally passive investments. You can do that as a real estate professional in a real estate syndication, but be careful. If you are truly a limited partner in a limited partnership, the legal structure, you can't do that. It has to be an LLC. So I also want to mention, we say that the vernacular we use in syndication world is GPLP. Everyone's either a general partner or a limited partner. Yes. But that could be in an LLC, limited liability company, where technically they're members, not limited partners, and things like that.
Yeah. That's a good thought. It's a good thought. So with all the depreciation and the tax code playing nice with us for here permanently until Congress decides to maybe unwind it, which I don't foresee them doing, at least in Trump's term. We have a 100% bonus we know for the next 4 years. We can count on that. We're not going to have this 80, 60 tail off a bonus. How are interest rates playing with you guys in this industry of targeting your properties? Because I guess that, from my uneducated syndication investing, it's tax law and interest rates. That, as an investor, that's what I'm looking at, I guess. But you can.
Yes, and interest rates move in cycles. There was a long period of time when they were low, and that was an amazing time to buy apartment complexes. Mm-hmm. You could put debt on them, on the the leverage that you could get was 75%. You could put a debt instrument on that, and that's tax efficient, for the partners. But the interest rate sensitivity really is what drives a big component of the valuations on apartment buildings. So right now we're probably coming to the end of a long interest rate environment that's been high. It feels like the interest rates, they have come down a little bit, but you think about it, it's just a use of cash when you're a business. Interest expense is a use of cash. So when interest rates are high for a sustained period of time, you're using a lot of cash to pay interest. And really you got fixed interest rates, or you have variable interest rates, and there's pros and cons to using both. They both have their cons and they both have their pros. And right now people are happy to have, if they have a fixed rate loan that's maybe lower from, a number of years back,
or
those properties are generating great cash flow right now. And I have deals like that. There's others that were, put variable rate loans on properties, and you can hedge that a little bit, but the cost of the hedge goes up as interest rates goes up too. So interest rates and taxes, that's really the story. People look at buildings and locations and things like that, but there's the financial component to the project as well. So
there was about a 6-year period, 2014 to 2020, where it seemed like no one could do wrong in multifamily syndications. But then we had a couple things happen. We had inflation, but also what happened with insurance? Like that's more than double or triple in some of your cases, right?
Yes, you really need to work with some good brokers, I think, to find the best possible insurance coverage. But even with the best brokers in the last, several years, that same period of time, there were a lot of perils. There's a lot of hail in Texas, wind. You've got hurricanes in other parts of the country, flooding down in Houston.
Freezing.
Yeah, so the insurance carriers, started recalculating, what the premiums needed to be to make that industry work. And a lot of groups did see some pretty significant increases in their insurance. We did too, but we did manage that pretty well. Property taxes, those go up.
we got to bring this one up, even
Yeah.
though Texas State is working on changing the law. I think they did change part of the law. The Assembly did on this, but this is where no syndicators are created equal. They're very different. As we saw in our client group, dozens and dozens of syndicators, the taxes, the interest, the insurance were killing them. Cash flow was going down, and they were just in a wait and try to survive 24. That was like, that's what everyone said. Just survive 24, survive to 25. We heard it over and over again. Some syndicators, like Jack here, they found a way to greatly mitigate that property tax. I know we're not going to go into that specific way, but they went out and found it. We're the tax team.
When I first heard about those structures, I thought they were too good to be true.
Yeah.
And started digging into it more and more, and found that one of the properties actually qualified, and it was accretive. And it was going to add to the value of the business, reduce expenses on cash, and we implemented that structure. But again, it goes to
that provided seriously needed cash flow.
Yes, it did. Yeah.
You're the only syndicator in a big group that we work with that had come up with that option. So
I'm a little unfamiliar because I think y'all may have worked on that deal together.
We did.
Share a little bit of light.
You were having a baby at the time, so
Yeah. Oh yeah. Yeah. That's
that would
Kevin
do
was
it.
having the baby.
That whole 9 months is probably a blur to me.
But he had actually found a way where you could give kind of
It's an affordable. It's an affordable housing component. So when the government's going to give you a tax break, they're going to want something, right?
Yes.
We can agree on that for sure, right?
There's no free lunch.
There's no free lunch, right?
Okay.
But
so it came down to in that property, it was average median income of the people renting the property, right, is compared to the average median income of that jurisdiction. Zip code is, you could use a zip code as an example, right? And that property was just kind of uniquely positioned where our market rents for a good chunk of the units were below that average median income threshold for qualifying. And we were able to implement that structure. You got to pay some attorneys, some fees to do that type of thing.
It was 100% worth it because
Yeah.
it lowered your taxes.
So you got a cut on your property tax?
Huge cut.
Yes. So we replaced the property tax with a ground lease, and the Housing Finance Corporation is the partner on that ends up owning the land. And you can unwind these structures too. So we put that in place. I can understand why the legislature acted so quickly on these. Again,
because hardly anyone was doing them. All of a sudden it got out.
They exploded. One, there was a lot of opportunity to reduce cash flow, negative cash flow, out to property taxes. And a number of groups found that, wow, I could actually implement this and still maintain my basic rent structure and be out ahead in terms of overall cash flow. So,
but it hurts the state's property tax collections quickly. So they quickly throttled that amount. But it was nice. You got in it. Your investors were.
On one of the projects, property taxes are over $1 million a year. So when that hole shows up in the city's budget or the taxing jurisdiction's budget, it's felt, and they react, and they lobbied, they lobbied the state legislature and closed it. Call it a loophole, I guess.
Well, how did that feel like, I guess, being the GP and you hold an investor meeting? What'd you do? And you're like, here's what we did. And all your investors celebrate, and I guess.
Well, I don't know, celebrating. I mean, that particular project was, the interest rates are still high on that deal.
Yeah.
So, but happy to able to at least preserve cash flow, by making that move.
Yeah. So if interest rates are high, and then let's say they drop a couple points.
Yeah.
I mean, you can always.
That can make a big difference.
You can always just refi. Is that a typical strategy that you see in your group specifically you could talk to? But if rates go down, cash out refi.
So we had a loan maturity last year, and 2024 was not a good year to have a loan maturity. But fortunately, we've been running the property that had that loan maturity. We've been running it really well. It's been 98% occupancy. We'd moved through our whole business plan in terms of renovations, and we were able to secure a fixed rate loan last year, cash out. So meaning that we could make a distribution to our investors, right? Tax-free cash in people's pockets. I would have liked it to have been more. Interest rates were still high and bouncing around, but we were able to lock in and keep that
And at least
the
know that it's going
volatility
to
of
cash flow.
It's cash
And your
flow, yeah.
investors' capital is preserved. Not only do they get some of it back, but what's
right.
left is
And we got to
preserved.
put some CapEx into the property as well, so.
So more depreciation goes down, right?
Yes.
So is that the general strategy? Let's say if I'm an LP
Mm-hmm.
and I want to get in this deal, and I'm going to get a bunch of depreciation on the front end because we're
Yes.
going to cost seg the purchase price.
Yes.
We're going to hopefully get some cash flow throughout its life. What's your hold period and what does an exit look like?
Yes.
For an
So we
investor?
always disclose, we prepare a business plan, and it's plan A, right? It's what is plan A? And our typical hold period, we always plan for a 5-year hold period. We've had some projects that one project was like 22 months and we were out, but usually it's going to take a little bit
That wasn't
longer.
the original intent, though. You just got an offer you couldn't refuse.
No, we accomplished the business plan. So in other projects, it takes a little longer than the 5 years to accomplish the business plan, but it's about communication. We prepare monthly written reports. We disclose to all of our investors the financial statements. They have access to them through a portal. We also got into the cadence of hosting, webinars, and most of our investors have our cell phone numbers. Well, actually a lot less people take advantage of that of our access that we provide than you would think. Which it's good. I mean, if that ever got crazy, I'd probably have to change that and do something different. But I welcome the opportunity to explain, what we're doing. I believe in what we're doing, and we're always faced with circumstances. How do you react to those circumstances? So.
And that's, again, not all syndicators are equal. So
No. Well, so there's a lot of people who got into syndication because they heard, like, oh wow, I could go in and be a general partner and make all this money, and
I get a fee up front
Yeah.
and on the back end.
it was like when I thought I was
Yeah.
a amazing day trader in the dot-com boom in the late 90s. I thought I was brilliant. I couldn't go wrong, and a lot of people got in, but those are the ones that shouldn't have, because now they're feeling it. Or their
well,
investors
maybe they didn't have the business acumen, or it was a partnership with, kind of some toxicity to it. I mean, you picked the wrong people to work with. Maybe you thought they had certain skills or a certain demeanor. They say the most difficult ship to sail is a partnership.
Yeah, it is.
So, my business partner, Alan Stewart, is a fantastic guy. Trust him with anything, He's got all the skills, the will to work, and hopefully he sees me the same way. But I think
He says so. He was
He
supposed
says
to be
so.
here today, but
yeah,
he
he
got
was
sick, unfortunately.
under the weather. So, but that's a nice thing about having a partner too. Is like somebody can pick up the work when the other one's got something going on, or is.
I feel like we could talk to you forever about this, but
Sure.
I just want to rewind a little bit for the fundamentals of investing in syndications. I guess, what would be the first 3 steps that you recommend? You already mentioned them, but can we reiterate them in summary form?
Sure. If you're going to be a limited partner and enjoy that role of not having to do much, you need to find somebody that you want to invest with. And there are plenty. I wouldn't search on syndicator necessarily. I would search on the types of investments you want to make. If it's real estate or others, you'll find them. I mean, they're all out there with content on YouTube, et cetera. And I think most people have a pretty good BS detector when they can tell.
There's some good BS out there.
There is a lot of strong BS out there. So you really need to talk to people that have invested with those groups before. And a lot of times they'll have open houses or different ways to meet up and get to know them. So that's rule number 1 is know the syndicator, and 2 is you got to buy into the business plan and understand all that structure, how the waterfall, how do you get paid, how do they get paid, what happens if the plan doesn't work, what is
Plan B,
it's not
C,
my
D,
return,
and E.
it's not my return on investment. I want to know what my return of investment is, because 100% loss is hard to recover from.
Yes.
You have a series of those, and I know people that just kind of got into a lot of these deals without thinking about things. There was, interest rates high, it could be challenging, but you can protect yourself from that by doing the right type of due diligence. Yeah.
So do your due diligence, but it is a great way if you want to get into real estate, you don't have a lot of time to pour into it. You want to diversify your portfolio, consider investing.
I would do that way. I would recommend somebody to do that before owning rental houses. I had a number of neighbors that got into the rental house business 20 some years ago, right back when I was still raising kids and going to soccer practice and all that. And I got into that too. And I could see a lot of people making mistakes.
Yeah.
You know, so I like the idea of being a passive investor in a deal that somebody else is running that I've already vetted, you know. So I'm in a number of them that are outside of real estate even, and it's a great way to raise money.
You know how doctors are bad patients? Are you a good investor? Are you a good LP investor? Do you?
Oh no, yes.
On the GP, like, why are you doing this?
You call them on the cell phone constantly?
I rarely.
I wouldn't have done that.
No, because I've already vetted them, and I know that they have a track. Yes, and I know that their judgment is. They probably know more than me about a specific topic, right? Because they're in it. But I have actually sometimes when there's some bumps in the road with deals, called the general partner and just talked to them and shared some thoughts. But you know, if you're trying to be combative, you know, and lose your,
it doesn't go well with anything.
No, like I think you should do X. No, it's more like, hey, I see you have this problem. You know, like how are you thinking about it? You know, just explore together. Yeah.
Well, I know you're not currently raising capital now, and I will say working with your group, you and Alan, chock full of integrity. And that's one thing that Mike and I look for when we are investing with people, when we are looking to do business with people, is money's one thing, but do you trust the person? Will they make the right decision on your behalf? And you and Alan have that. And so I know you're not raising money now, but let's say you open up a deal, how do people find you? And
yeah, so I have a website, jacklangenberg.com, easy to find. It goes into my background in a number of different areas, but you know, I'm a sommelier, I'm a #1 best-selling author. I mean, I got a lot of, you know, those type of things that I was interested in along the way, but you know, nothing gets me more excited than putting together a deal. And right now, with interest rates the way they are, there's not a lot that makes sense. There are some interesting ones out there. Talk to some banks that are trying to unload.
But you're looking.
We're definitely looking and staying disciplined and running the assets that we have. So
nice. Well, we'll find that in the show notes, jacklangenberg.com. And thank you for being here. There is hidden money in the tax code, even in syndications, actually, especially in syndications. Just imagine tax-free distributions, not like the dividends you get in the stock market, tax-free distributions. Thank you very much for being here, Jack.
Yeah, my pleasure.